Whitney, welcome to the show. So glad to have you on today. Look forward to speaking with you.
Oh, thank you so much for having me on. This is going to be fun.
Yeah, I agree. I agree. We're going to help a bunch of people. And you are in the real estate world, which is, I'm in the real estate world as well. We talk a lot about real estate on this show. I was doing some research on you and I read a very interesting story on your LinkedIn profile about your first real estate deal that you did way back when. That was very successful, but then the second one, maybe not so successful. And I was like, man, I really want to hear about that story. So, maybe if you could, kind of take us back to how you got started in real estate in those first two deals and how it led to where you are now.
Well, I'll start with where I am at now, only because we might need to. I don't know how much time we have for the other
Yeah.
story, but so my name is Whitney. I'm the director of investor education here at PassiveInvesting.com. And so where I'm at now is I get to work with investors and help them understand private equity investing, how to invest truly passively, where they don't have to operate a deal, but they can invest in large institutional grade assets for cash flow, equity, and tax benefits, and as well as diversification and myriad of other things. We do multifamily, self-storage, car washes, hotels, and also first position real estate debt.
Hmm.
But I didn't start off with a real estate degree. I didn't start off like where I'm at today, like with this, working for a large firm with, an extensive portfolio of thousands and thousands of units, and 1.3 billion assets under management. I started off as a single family investor in 2002, and completely by accident, I had a house with a significant other, and the relationship fell apart. And I everything was under my name, the loan, the utilities, everything. And as a young 20 something, I kind of was a little scared of what to do. It was a huge growing up moment for me. So I stuffed the house full of roommates and who didn't mind living in a construction zone, completed the rehab. I mean, everything needed to be redone on this property. There were psychedelic daisies painted on the walls, shag green carpet, with beautiful hardwood floors underneath, but I had no idea how to refinish them. So paid a lot of friends in beer, pizza, sushi, and over the next 11 months, got this property put back together, and probably committed my number one real estate investing mistake, which is I sold the property.
Hmm.
It was right next to a college campus. I could have just moved on, traded up for the next property, and started my rental career, but didn't do that. I thought it was the hottest thing since sliced bread, and bought a mountain home, violated every law of real estate. Number one law: location, location, location. And I bought in a mountain community on the side of a mountain with 19 steps from the driveway to the front porch, and couldn't sell the property when I needed to exit, like right before the 2008 crisis. And the mountain community started to soften a couple of years before that
Yeah.
2008 crisis. I was in a horrible loan. I was like, I just please like not let this property sink me. And probably what you're referring to is when it took me a year to get the property under contract. I actually had an offer 2 days after putting it on the market, and I was like, no way am I going to take that lowball offer. I look at what I did on my last property. Like, certainly I can do better. Year later, took the same offer, just from a different person, and probably a more poorly structured deal. But we ended up having to dig out a retaining wall on the backside of the property and get that replaced during the due diligence phase. And fortunately, all I did was bring money to the table. My realtor and the buyer orchestrated all of the repairs. He got it all locked up. They were locked in. A $6,000 retaining wall ended up costing $30,000 by the time they settled on materials and all this. And the whole entire time, I said, guys, my neighbor who lives uphill from me, I'm like, she has a tenant living in a school bus that sits on the retaining wall. Just tell her to move the bus. And they had to repair the wall. They moved the bus to my neighbor's property, and his wall failed. And I was like, guys, it's the bus. Like, it doesn't matter. You move the bus into place, you put the weight, like, no, this wall is supposed to be bomb proof, everything. We closed the deal, and less than 24 hours later, I get a call from my realtor, and you can hear a lot of screaming, put down your weapons, that type of yelling going on. And
Wow.
the bus had fallen into the roof of the house. The tenant moved the bus back into position behind the property. It fell into the roof of the house, and with the guy in the property or in the bus. The police are trying to, extract him from the bus. And he's like, don't come near me, pumping his shotguns. And I was like, am I on the hook for this? And he was like, no, that ship long sailed. Like, I just thought you would want to know that you're right. It was the bus. And I'm like, okay, please don't call me again.
Wow. Wow. Well, if you're in real estate long enough, you're going to have a crazy story or two like that.
Oh my God, we can go on for hours, but I would say I've had way more deals work out very well than I do crazy stories.
Yeah, and that's the way it's supposed to go if you stick with it and you don't. I mean, you certainly could have, cashed in at that point, but you chose not to. And now, as you mentioned, I love what you said about, I want to talk to you about passive investing, because that word is thrown around all the time, passive. And you said something, I think you might have said truly passive, because, passive activity is not, I mean, it means you do nothing, essentially. You always have to put some effort in, right? But what you're talking about is a minimal amount of effort up front, and then you're getting the return, all these benefits but tax. So could you expand on what you said initially when you said what you do now? Because a lot of the listeners are going to be super interested in that, because they're working busy corporate W-2 jobs, and they want to look for other ways to make money without trading their time for dollars.
Absolutely. Well, so, passive income it's a sliding scale like anything else. Right. Even in the W-2 world, there's a sliding scale. You can trade your time for $10 or $100 an hour. Or you can trade your time for commissions and bonuses, and even make more money. So that it's no different in quote unquote passive real estate. And so and I need to break this up. There's passive in terms of your time, and then passive in terms of what the IRS sees. So the IRS deems passive investing is you buy a property once, you put a tenant in it, and you no longer have, you're leveraged in your time, right? The money that's coming in, is quote unquote passive. You're not trading your time to bring that money in. But as anybody who's ever owned a single family residence, and rented out their property, you're doing a lot. You got to find the property, you got to secure the loan, you manage the property, you got to tenant the property. Maybe you get property management to help you out with all this, and you get to leverage yourself a little bit more. But you're still handling all the day-to-day decisions. Why? Because you're the operator of the property. You're the CEO and the operator of that property. Now, when we talk about passive investing, like what we do here in private equity, you as an investor, you are truly sitting in the CEO position. You're going to research who the operator is, the markets they invest in, and you're going to research the deal. And then you're going to hire the operator to run that deal on your behalf. So what do you get? Not only do you get, you trade out the leverage, you get to leverage somebody else's knowledge and expertise on, maybe you don't know how to run a 252 unit asset. Great, you can invest in something that's larger and more institutional grade, has scalability, is valued different, and has the propensity to make larger returns than single family property. You get to, leverage their team. You get to leverage their ability to secure credit and lending. You get to, and more importantly, not have that loan under your name. So you're not taking on that risk. You're offered protections by being in a limited partner position. So you're not signing on the loan. So you're just, your risk is limited at the LLC level, truly limited at the LLC level. And we can go into more on that, here in a little bit. But more importantly, you get your time back. So, when you invest in a large private equity deal, such as what we do, you're going to, get to know, love, and trust us. You're going to, understand the markets we're investing in, our deals. And once you write a check into one of our deals, you're technically done. Okay. You have no more operational day-to-day control. That's why those first three pieces, vetting the operator, the market, and deal, are so important. Okay. But what you get back is your number one non-renewable resource, which is your time. Okay. Because once you spend it, it's gone. You can't get it back. You can always get more money, right?
Yep.
But once you spend your time, it's gone. Now, here's the thing. Now, I know a lot of people that, I talk to, I work with investors, I coach investors, and they're like, but that's a huge leap for me, working my day job to investing in passive real estate. Like, don't I need to earn my stripes? No. Like, if you have a higher and better use in your job, say like you're a high income earner, like doctor, lawyer, engineer, tech worker, it may behoove you just to jump into private real estate. You don't have, there's no degree path here. You don't have to earn your stripes. But maybe there's somebody here listening that is like, hey, I don't have 25, 50, 75, $100,000 to invest in an asset. I want to get to that point. Well, there's nothing wrong getting into controlled real estate, single family, small multifamily investing. For some people like me, I had to do that. I had to scale a portfolio of over 30 single family homes before I actually had the income and the equity to be able to write these larger checks. So the path isn't the same for everybody.
Yeah, 100%. There, that's one of the things that's great about real estate is there are so many options to make money, right? You just have to figure out what's best for you at this particular stage in your life. And I think a lot of people overlook this. They overlook the fact that, especially if they're a homeowner, they're overlooking their primary residence as a way to get started. That's what you did. You were kind of forced into the situation, but you took advantage of it versus just ridding well, you did sell it, but you could have done some other stuff with that. And that, really launched your career. I'm super interested in hearing about the car washes because I keep hearing this. And I guess, for lack of a better phrase, it's not maybe the most exciting business, but I keep hearing that it's super, super lucrative, or it can be. So maybe if you could expand on the benefits of car washes and why you're investing in them.
Well, I just want to comment on what you said, that it doesn't seem to be super sexy or, enticing. Investing isn't meant to be that. Like, if you want excitement, like set aside a small part of your monies and go to Vegas or, hike a 14er, like get your excitement some other way. Your investments, you they should be boring, right? Like, they should be consistent and boring. They should abide by the 7 pillars of wealth building and just work like clockwork for you. Awesome. Now, as far as car washes, first of all, we'll pick apart really quickly how there's different types of car washes, but you need to understand that you're buying a business that has, if you buy it right, and most people don't, this is the key. They're buying the business and thinking they got the business and the land. And oftentimes they don't get the land. Okay. So you need to buy the business and the land. And why do you want that? Because if you can't control the land, you got a landlord literally that can sell the land right out from underneath you, increase your rents. You now are no longer in control of your profit and loss statement. Now, so it's super important to buy it right. Now, for us, there's multiple types of car washes. We focus on express car washes, and I'll tell you why. Because all of us know about those in the DIY car washes. You drive your car in a bay, you drop some quarters in, you got the spray hose and the scrub brush, and you pray your 10-year-old doesn't spray you down with the hose like mine does to me. We have a car that we have to take through one of those bays because it doesn't fit into anything else. We have a camper van. So I still have to frequent one of those, but that's very, it's not scalable. You only have 10 bays. You can only get 10 people through maybe max an hour. Mm-hmm. So you can only make so much money there. Now there's other perks to that as well. And we can go into that, but then you have your in-bay automatics. So those are the ones that are attached to gas service stations. Got like a little mini conveyor belt. You can maybe get 2 or 3 cars through. pretty quickly. But if you're the fourth or fifth car in line, good luck. You're going to go do something else.
Yeah.
Then you have the full service car wash, which is on the other end. That's where you have maybe like a 20 or 30-foot long tunnel and you drive a car through and you got an army of people vacuuming the cars and an army of people drying the cars. Those are very labor intensive. Then you got this sweet spot in the middle, the express tunnel car washes, where you can crank through 400 or 500 cars an hour and operate it with 2 or 3 people, full-time employees. And so you can modulate the electricity usage, the water usage, the chemical usage. And you can provide, quite honestly, more times than not, a better product than you could in a DIY situation or in a full service situation. Yeah. So that's really where we focus on the sweet spot. And why is it so profitable is because of volume. And we can keep the expenses low on that. So when you evaluate a business, it's all about the net operating income or expected gross income, the profit. What can you bring in this profit? So how are the 3 levers you can make more profit? Increase your income, decrease your expenses, and oh, by the way, you can do both. And that's what express car washes allow us to do.
Awesome. Next time I go to a car wash, I'll never look at it the same. I haven't been because I've been hearing all about this. Did you say 3 to 400 cars per hour? Is that what you said?
4 to 500.
4 to 500. Okay. That almost seems not believable, but I do believe it.
I'm sorry. Wait, hold on. Time out.
Yeah.
Rewind. 4 to 500 a day.
A day. Okay. My goodness. So I'm going to end this show.
So you can get through a high number of volume an hour. Yeah. For those people whose jaws were on the floor, like dragging, okay, we can pick them up a little bit, but yeah, that's still huge numbers. Like if you have a 10 bay, a 10 bay, like in place automatic, you might get 40 or 50 through, like, you're 10xing your income. So,
yeah. No, that's still a lot of cars, and everyone's probably paying whatever 5, 6, 7. Some are paying more per wash. So, I love that.
Well, here's the thing: is that when you have that type of scale and efficiency, people are more apt to pay in a subscription model, right? Because they know if they pull in probably any time of day, they will get served within 5 minutes or less. Okay. And so, you can't guarantee that with the other types of car washes. I know we have a full service car wash here in town, and it'll be, my husband and I we have to decide, we're going to wash the car Saturday, because we might have to pop in line 3 or 4 times throughout that day to figure out when is a good time to get in line. Or we're like 20 or 30 cars deep. It's an hour-long process, right? But when people can get served fast, they're going to pay, good, fast, and cheap, right? Like you can get, definitely 2. That's what people strive for. In this case, you can get all 3. They'll pay a subscription model for that. And so that subscription model, we're generally charging $25 to $45 a month, depending on how many bells and whistles somebody wants with their car wash. Different types of waxes. Do they want to wash their dog at the same time they wash the car? Like for me, sign me up. I mean, I have a 60-pound puppy, and I'm like, please let me wash her at the same time. The next question most investors ask is like, well, if I'm paying a subscription model, what prevents me from washing my car every single day? Well, nothing other than time. Yeah. But most subscribers to a package like this wash their cars 1.8 times a month. Okay. And they're doing this almost 12 months a year. Okay. And the average wash, just the water, the electricity, and the chemicals that go into the wash, salaries and that, like for the full-time employees, but there's a hefty margin there. And you can stabilize your income year round. Whereas like if you have like a DIY car wash, a coin operated one, summer months, spring, summer, and early fall are going to be super busy. Your winter months are going to be, not nearly as busy. With a subscription model, it's kind of operates more like a self-storage in a way.
Which you do that as well, from what I understand. Do you look to purchase car washes that are already in place, or you are building from the ground up?
Both. Okay. Yeah. So we're looking to scale a portfolio in the next 4 years, we're already 1 year in, of 250 to 300 locations. And that's going to require us to do it both ways, through direct acquisition and then also through development. Now, the acquisitions, who are we acquiring from? Well, we're acquiring from mom and pop operators that are tired. There are a lot of people that got into this business, kind of going, wow, I heard car washes were lucrative. I'm going to do everything I can, and I'm going to, either develop my own or I'm going to go acquire my own. And guys, it takes about 1.5 million to develop your own minimally. So you got to acquire the land, you got to probably acquire some sort of brand, purchase the equipment. It's a huge upfront cost. Most people don't have those kind of checks. Now, they might realize that they need to scale locations, right? Like, 4, maybe 5 locations. But then they realize there's no property management for this. So what are they now? They're now the operator again. Okay. It's just, instead of having 5 single family properties, they now have 5 operating businesses that it's really hard for them to step away. So we're purchasing from these mom and pop operators that are super tired. Now, you might be scratching your head going, well, if there's no property management and you guys are scaling a portfolio of 250 to 300 locations, like, how are you solving that problem? Well, we're actually building the first from the ground floor up, the first third-party property management company for car washes. And we're going to be focused quarterly on our portfolio. And not only is that going to help us scale, but it's also going to help us with the exits of these portfolios, because now, it's more enticing to IPO. It's also more enticing to a REIT or another private equity group, because they don't want to manage properties either. They want to buy a income producing portfolio. So it gives us a lot of flexibility. But yeah, like it's very cool. It's a very cool industry, and it's very new. Think about it, self-storage, like back in 2006, 7, and 8. We're just on the very beginning of the infancy of what could happen here. It's a $33 billion industry, and there's only about 29,000 car washes throughout the United States. And so, forgive me, my numbers might be off by a couple thousand, but, there's a lot of growth here. And now a lot of people might be scratching their head and be like, that's a lot of car washes. If you think about it, there's gas stations, multiple gas stations on a corner. There's multiple carb lube, oil change places within a town.
Yeah.
And even with the move to electric vehicles, even electric vehicles need to be washed. So
totally. And I just think that with the way the world is now, I mean, I can't remember the last time I physically hand washed my car. I mean, seriously, especially living here in Illinois and Chicago in the winters. I mean, you have to get your car washed multiple times because, the weather just, destroys it.
Oh yeah, I live in Colorado. We get mag chloride sprayed on the streets to help, de-ice them. And yeah, you have to get that stuff off your car. It'll just destroy it.
Yeah, that was great. You really shared. I think a lot of people are going to be interested in this. I know that I am, and I'm just keeping hearing about it. Again, it's in its infancy. It sounds like kind of like self-storage was, years and years ago. You kind of snuck something in there that I want to go back to before you started talking about car washes. You said the seven pillars of wealth building. We just kind of brushed over it. So I think that would be a huge add to the listeners today. If you could expand on that, please.
Yeah, so I don't pretend to own the concept, but I think, what I've done is kind of packaged it up nicely for people to understand. So, for anybody who kind of gets down this, financial independence rabbit hole, seeking financial freedom, trying to leave their W-2 job, part of the question is, how do I know when I start investing in assets? And we're not talking about underwriting. We're not talking about the spreadsheet part, but how do I know which asset class to go into? You can go into notes and real estate and stocks, bonds, mutual funds, but what makes them different? Why do people make money and lose money? And I think it in my thousands of books that I've read, people that I've interviewed, I've distilled it down to 7 principles. And a lot of these I learned from Warren Buffett, Ray Dalio, some of the major investors out there. is one, you got to invest for capital preservation. I think we are in the market cycle right now. We're recording in January 2023. We're in a market cycle where capital preservation is utmost importance, right?
Mhm.
Don't lose money. Okay. Warren Buffett's rule number one. Rule number two, see rule number one, right? Quite simply. Two, invest for cash flow. Now, cash flow in some asset classes are really compressed right now. But there will be, multifamily cycles different from self-storage, with cycles different from car washes and the like. Making sure the asset has some sort of cash flow now to demonstrate stability, and also, help cover all the expenses on the asset. Number three, investing for equity growth. Now, a lot of people, if your real estate assets right now include your primary residence, you're hoping you're in a market where you can get natural equity. But I also look for opportunities that have forced equity, where I can manipulate the income and the expenses on the property to create a larger gap in that net operating income and grow it. Mm-hmm. Why? Because those larger commercial real estate assets, this does not hold true for single family homes, or even small 1 to 4 units. And I would say even 50 units and below, it's challenging. But when you get 50 units and above, you have your asset is valuated on some sort of multiple or division of that net operating income. Okay, if you're talking commercial real estate, it's net operating income divided by the market cap rate. That gives you the value of the asset. Right. If I can grow the net operating income, even if the cap rate gets larger, gets worse, the market gets worse, the cap rate will get larger, I'm still making money. Okay, I'm still increasing the value. Investor tax benefits. That's why I love real estate. You have tax benefits in business, but I love, love, love real estate. Direct ownership of real estate, private equity real estate, is because I can take advantage of one of the largest tax shelters out there, which is depreciation, accelerated depreciation. Okay. And right now we still have bonus depreciation, even though it's stepping down. Okay. And that's bonus depreciation is more of an incentive than it is an accounting method, but I get to take advantage of that. Also, I get to take advantage of the 1031 exchange to continue to defer my capital gains tax and my depreciation recapture tax. I get to take advantage of that. So the time value of money in real estate is immense. Like, that's how this asset class, the overarching asset class, makes more millionaires than billionaires, because of they understand these first 4 core principles. They can make money in almost any market cycle. Now, I said there were 7. The other 3 are kind of more rules. One, right now in this market, you have to invest in assets with smart leverage. If there's going to be any leverage at all, it has to be used smartly, because leverage can help you make money, but it can also help you lose money. It can cut both ways. I am looking for assets with fixed interest rate debt. Now, I know there's a huge argument out there for, ARM loans right now. It depends on how long you're going to hold your asset. It depends on what the business plan is on the asset. But I liked fixed interest rate, at least for, 5, 7, 10 years, at least get it to the length of the business plan and options to extend it past there. But smart debt, okay? This is not the time to monkey around with debt. And then, making sure you're investing in assets that provide an inflation hedge. Most assets do not. Real estate does. I can buy it in today's dollars, and as the dollar devalues, I'm paying it back with dollars that have less purchasing power. So I'm reaping the benefit of buying an asset today and preserving it in today's dollars, and paying it back with future dollars that are less powerful. I don't see that trend going away. And then the last wealth building is making sure you invest with amazing operators. Okay. Now, the operator can be you, which means you need to invest in yourself, your education, and become top notch in your class. Really understand what you're doing. Don't leave it up. Don't get out of the stocks, bonds, and mutual fund market only to kind of like pass off the buck on your real estate investing to somebody else. Right? Do your own due diligence on you, or not due diligence, but your own training on you. if you're going to invest in private equity, okay, in these larger deals like what we do, you got to learn how to underwrite the operator, okay, because not all operators are created equal.
Yeah.
And here's the thing: when people transition out of investing in stocks, bonds, and mutual fund, what are they doing? They're chasing yield. Okay, they've been trained to chase yield. And if you take that same type of mentality into real estate investing, especially in private equity investing, you probably at some point in time are going to get burned.
Okay. Wow, that was amazing. Thank you for sharing that. It was very educational. I wrote them all down.
I usually do that. That was like an hour and a half talk presentation in like 5 minutes. There you go.
All right. All right. Is that presentation available somewhere
Yeah.
that people can go watch?
Yeah, you can find it at passiveinvesting.com. Like, we're getting those all posted there, but also on our YouTube page. And if people just reach out to me at Whitney@passiveinvesting.com, I can send them the link.
Awesome. And that's where people would go, because I was going to ask you, where can folks go to learn more about you and potentially invest in what you're, all these wonderful things you're talking about?
Yeah, so there is a special landing page on the passiveinvesting.com site, and it is called passiveinvestingwithwhitney.com. And you can't get these resources anywhere else but at that landing page. And, there I have a book that walks investors through how to start evaluating private equity real estate and just the 7 steps it takes to get invested in their first deal. And a lot of that is front loaded. You don't have to do the same 7 steps all the time, but especially when you're new to the space, you got to understand your goals, your risk tolerance, how to vet operators, markets, and deals, and then we can kind of turn you loose from there.
Yeah, it's great that you're educating the investor on how to choose the operator, because that's difficult. There's so many of them out there. And evaluating, you're really kind of relying on them to present the information to you and trusting the information and the I know they don't guarantee the returns, but the returns that you're looking for. You invest 50, 75, $100,000, whatever it is, you expect some multiple of that in cash flow, while the asset is, how long do you typically hold your assets for, in general?
Yeah, well, it depends on which asset class, but typically what we show our investors is a 5-year pro forma. So we're looking to complete our business plan on any one asset in 5 years. Unless there's a special case, we might show them a 7-year pro forma.
Okay.
But we are actually looking even though we show 5 years, we're looking to wrap up our projects, ideally in 3. But we give ourselves a couple extra years in there just as a buffer room, to, because again, like if you hit a market cycle like this, you could sell an asset a year ago. You can't sell it right now, for the price that you wanted. So you just need to be able to not be pressured to have to sell in a down market. Okay.
And since you brought up the market, I certainly don't want to put you on the spot. I'm not asking you to make any predictions. Maybe if you could just share some, it's January, it's the beginning of January here as we record this. Maybe what are some of your thoughts in terms of the real estate market? Like, what do you feel like? What are you seeing? What should people be concerned about or not concerned about? Because again, you turn the TV on, the world is ending.
First of all, turn off your TV.
Yeah, there you go.
Because I'm serious about that. Turn off your TV, remove the news feed from your news or from your phone. Get off all of those websites. Don't have them hit your inbox. One, that'll just destroy your happiness. It'll create anxiety. 2, you go back to those 7 principles that I named, because if you're investing for all those 7 principles, okay, you take those 7 principles and you're investing with high quality operators, even if you're the operator, you're going to be making money in any business cycle. If your cash flow dips down, but you're in a nice equity position on your asset, you'll make your money there. If you're getting nice large tax benefits, you'll make money there. If you've locked in good debt that somebody else is paying down for you, you're making money there. Okay, so that's why I really hedge on these pillars. I think for today's market, it is real. Okay. That's why you have to really, take a look at those assets and probably say no to most of the things that are crossing your desk. Okay. Now, as far as like future looking, and let me just, back it up just a second. If you find a good deal, even if the debt on it is 7-8%, if it is a high quality deal and it's going to make money now, lock it in, because you can always refinance later at a later point in time. But if it works with that debt today, amazing, because there's going to be a cycle where the interest rates fall again. I can't predict when that'll happen. But then you'll be able to renegotiate your debt. And guess what? Pull money out cash, tax free, but pull out cash. As far as future looking, let me just take the multifamily class. Pipelines have really slowed down right now. We've had to wait for seller expectations to align with what's really going on in the market. But here's not a cool thing. I mean, I don't pretend it's cool. But a lot of people got themselves in 2020 and early 2021 they started using bridge debt to buy properties. Now, why did they do that? Because they wanted to amplify cash flow as these asset prices raised. Those bridge debts probably only had a 3-year lockout on them. That's going to start adjusting probably towards the end of 2023 into 2024. So, not everybody's going to be able to renegotiate that debt, which is going to create a lot of buying opportunities for people. So we are anticipating that capital markets stabilize and even come down a little bit before then. So we don't really, predict that we're going to see a lot of carnage there, but there are going to be operators that are going to be very pressured to sell their assets. Maybe they didn't purchase a cap rate or not a cap rate, an interest rate lock on the asset. Maybe they didn't purchase any extensions, or they didn't negotiate any extensions. So their backs are going to be really up against the wall. So, you want to be with a smart operator that knows how to utilize that debt really well.
Yeah. Your rule number 5, smart leverage. So, I think that a lot of us, because it went on for so long, Whitney, where you just thought that interest rates were going to be below 4% forever.
Yeah, I just saw a graph yesterday, and I wanted to say it was from Green Street. Don't quote me on that, but maybe Marcus Millichap. And interest rates, they were supposed to glide up to 4% by the end of the year, 4.1 to 4.5%. That was the glide that was supposed to happen by the end of 2022. And then where we landed, nowhere near that. Well above that, almost double. So it kind of harkens back to the 1970s. And I can understand. I mean, there are still many investors that lived through that time, right? Like for me, like, the .com crash and then also the financial crisis is like kind of like my life crises that I've lived through. So there is a lot of, it kind of goes back to the psychology of money. If you've ever read that book by Morgan Housel, some of these like traumas can get ingrained. And so I understand why people are triggered, but again, you kind of have to take a big breath and go back to investing principles. Like, how have people made money in nearly every single market is because they invested based on principle and sound fundamentals and not trying to find an adrenaline rush or an identity even with their real estate investing.
That's so great. The adrenaline rush part. I mean, heck, I've been guilty of that. I can tell you that. I mean, it's hard not to, right? Super awesome, Whitney. So we're gonna tell us real quick, because we're wrapping up here in a little bit, but tell us real quick about your podcast. You have a podcast. Let's talk about that as well. And where can we find that?
Yeah, definitely. It's called the Passive Investing Made Simple Show. And you can find it on YouTube under the passiveinvesting.com YouTube page. And you can also find it on your favorite pod player of choice. And awesome. There we just talk about all things passive investing, so you can go into your first or next deal with confidence.
Awesome. A lot of our listeners are going to be super interested in that because, again, we're working busy W-2s and we're trying to make money in other ways. So go check out Whitney's show, please. Other than the 7 pillars, Whitney, Obviously, you've created some habits that have made you successful over the years. Could you highlight for us maybe one or two that maybe you weren't doing before you got into investing that have really been a game changer for you that you still utilize today?
Yeah, definitely. So I'll give a book and then I'll extrapolate what I got from that book. And it's The One Thing by Gary Keller and Jay Papasan. And I'm sure very underrated book, I think, because it's, and you have to read it multiple times. If you only read it once, I would challenge yourself, read it one time a year, because every single year you're going to pull out something additional from it. You'll be like, oh, holy smokes, I am not doing that. But one of the habits that came out of that, for number one, I, learned how to organize my time based on priority and really kind of reevaluate how I wanted my schedule to look. And on the surface, that's what a lot of people get. But I started, they had a quick 2-page question and answers that couples could do, or and couple can mean business partners, it can be married couple, or you can even answer these for yourself, but kind of a life design type of question and answer sheet, and it tackles multiple areas of life. Now, my husband and I started doing that on an annual basis, and the first year was like, we were like, whoa. I'm the goal setter. He's not. He was like, can we go do something else now? Like, this is like pulling teeth. Yeah. But now we look forward to it every year because one, we've reduced a lot of the friction out of it, because a lot of these questions we've kind of already grappled with over time. But it's really about planning your life and not letting your life plan you, which is how so many of us live. And even if you're in a W-2 job, plan your life. And I really encourage people to go, check out that book and do a goal setting retreat once or twice a year, with themselves or with their significant others, and really focus on how do you want your life to look.
Yeah, it's amazing how many people don't do that.
I preached to my friends about it, and one started this year. I was like, yay!
Yeah. Well, if you just think about the time, all the time, because I mean, you probably agree with this. A lot of us are doing stuff that doesn't matter, right? We waste our time doing stuff that doesn't matter, doesn't pay us a return. But when it comes to our life, as you said, plan the vision for your life, we won't spend the time, whether, I don't know how long your retreat is, whether it's a half a day or a full day. That to me is worth the time spent, especially if then you start aligning your daily principles and activities with that future vision. I assume that's what you would recommend to the listeners as well.
Oh, absolutely. Like flip-flopping your time. Like if you feel like you're out constantly stressed and behind the 8 ball, like, look at all those ways that you're your own worst enemy, and purge those and get those out. Now, here's the thing. We're so ingrained. I don't think people really realize how much of a product of the system they are, or a part of the algorithm. Like, if I don't have social media on my phone at all, like I don't look at it, I don't check news. Now, don't get me wrong, the news will find me. It's hard to escape it. Yeah. But I have hours back, in my life because of those habits. Now it's hard, right? Like, it's physically, like, this is harkening back to, like, my degrees. Like, my degrees are, in public health and nutrition. I mean, our environment is programmed to hit our dopamine switch every single day, as many times as possible. Like, every app that you have on your phone is meant to grab your attention and keep it on it as much as possible. So, learn how to take back your time and your attention. And those are non-renewable resources. We said at the beginning, once you spent them, they're gone. Like, it will be hard to break, because you're literally breaking the same switch that a drug stimulates. Like, opioids hit a dopamine receptor. Every time your phone dings or you see a red button, it hits that dopamine receptor. But if you can break that and spend it doing something you love. Spend it with your family. Like, you'll be glad you did it. But it's hard. It's an addiction. We have to break it.
Very challenging indeed. I kudos to you for taking it off your phone. That's awesome. Whitney, this has been really tremendous. You've shared such great stories. I love the stories. I love the insight and the the 7 pillars are awesome. Anything that I didn't ask you that you maybe wanted to share as we wrap up? Any final thoughts before we end today?
The one, I mean, we can go on forever, because I just love talking about real estate and helping people kind of find their path in the world here, because it's different for everybody. But the parting comment I would leave people with is ready, aim, or ready, fire, aim. Like, if you're ready to, break the W-2 prison, take action, any action. Right. Ideally, if you have a plan in place and you can execute on that plan, amazing. But you got to start taking steps forward and testing, because every step forward you take is an experiment to see if it works or it doesn't. And if you never take a step forward, you don't get that feedback to understand if you're going in the right direction.
Oh, awesome. Love it. Perfect way to end it. Ready, fire, aim. Awesome. Whitney, thanks so much for sharing your valuable time today. And I hope everyone has a super awesome day.